All right. So one of the first things to talk about is whether or not you're a first-time home buyer. And some people who haven't owned a home in the last 3 years, although they may have owned a home in the past, are considered a first-time home buyer. There are certain benefits that a first-time home buyer could take advantage of. These are things such as low down payment options, or sometimes a no down payment option. That's something that's available. There are certain mortgage products and types of loans that are available only to people who haven't owned a home in the last 3 years. And there are also down payment assistance programs and things that are available, again, to people who haven't owned a home in the last 3 years. We're going to talk through the different steps to purchase a home. The very first step is exploring the financing component and getting a pre-qualification letter. You may have heard this called a pre-approval letter or a pre-qualification. Certain people and realtors and sellers may use these interchangeably. There is a difference between a pre-qualification and a pre-approval, and we'll chat about that in a bit. Then you want to make sure that you find a real estate agent that you're comfortable working with, and we can talk about the contracts. Then you would make your offer with your agent and sign a purchase and sales agreement, and we'll talk about securing the financing. All right, so who are the key players? So the first person that you're going to deal with in the home buying loan process is the mortgage loan originator or mortgage loan officer. So I'm an MLO. That's your contact at the credit union or bank that you'd work with, who's going to oversee the application, who's going to potentially take the application with you and assist you through the entire process up until closing. You're also going to work with a buyer's agent. The buyer's agent is the individual that is going to assist you in making hopefully the lowest offer or the best offer on the property that you hope to purchase. And they are focusing on your interests. This is going to be pretty much the exact opposite of a listing agent. So the listing agent is working directly for the seller, and the seller would like the highest price on the property they're trying to sell. So the listing agent is responsible to get the highest price. There are instances where you might have an agent who plays the role of a dual agent, where they are both representing the seller and you, the buyer. This is it's becoming more common. It used to be very rare, but it is an option as well. Some of the other people that you're going to work with potentially, so a title company, or in Massachusetts, you're going to be working with an attorney who represents the lender that you're going to be getting your loan with. So a title company's job is to research the history of the property to make sure that there are no problems with the history of ownership, and to check if there are any liens that are problematic on the property, and to know the history and to certify that. They also will handle the actual closing on the closing date of your purchase. They'll handle all the paperwork. This is something that, although it directly is benefiting the lender that you choose to work with, you do pay for this as the buyer. You can choose to have your own buyer's attorney. In Massachusetts, this is a right, and they are going to be there to help resolve any potential obstacles to the closing. It used to be very common. It's not that common anymore, but it's certainly always an option for you to use an attorney to verify the information and help you with your closing. That would also be paid for you as the buyer. And then a seller's attorney, unlikely that you'd have a whole lot of communication with a seller's attorney unless you're doing a type of sale where it's for sale by owner and there aren't real estate agents involved. This does pop up from time to time. If you see listings online that say for sale by owner, you're likely to deal with a seller's attorney.
Liz, if I can jump in real quick, I'm sorry. I forgot to ask at the beginning of this, is anybody on the call? We have invited our MITRE branch in Virginia. Is anybody on the call from Virginia? If you could just give me a hand clap or some reaction, just so that if we want to make sure we cover anybody in Virginia. You can also just drop me a note in the chat and I can let Liz know. So I don't see any hands, Liz. So I think we're good just for Massachusetts.
Awesome. Thanks, Bill.
Yep.
All right. So one of the questions that I get pretty often is, do I really need a real estate agent? For what reason do I really need an agent? And these are the major factors. So real estate agents, assuming that they've worked in the industry for a while, they do have market knowledge and truly know how prices of properties, really ought to be, and that's very much related to your offer amount. Real estate agents will spend the time helping you look for what you want and should be coming up with properties that really meet your needs. Although I know a lot of people do find the listings that they want to see themselves because listings are so readily accessible to us online. There are oftentimes listings that are available to real estate agents that haven't yet been posted online. And so having someone who really understands what you're looking for can give you an advantage in that way. Agents tend to know how to negotiate things like repairs or negotiate sales prices. They can help protect you in ways that you may not be able to protect yourself, in terms of understanding the different types of contingencies and clauses that can be drawn into a contract. They know what is most likely to work in a market like the one we're in now, when there are so many offers for a single property and time is so limited. Agents really know the best way to get an offer accepted. And so an agent is likely going to be able to do that for you. And they can help figure out if concessions are possible. So a concession is, for instance, asking a seller to pay for some of your closing costs. That's the most common one. So they can help you determine if that's possible in the type of situation that you're applying for, making an offer for rather. And they can also do the coordination. So this is really the most critical, is that if you are thinking about potentially going on your own to make offers without an agent, there is a lot of work to be done in terms of communicating with the seller's parties and title companies, and ensuring that all the paperwork is done properly. And that's something that the agent is already doing. So just very helpful. The other thing I'd say is that there are so many agents available that it's really important to interview them and find one that you have a good rapport with. All right, so the other thing, and this is just something that I get as one of the most common questions, is what happens if I need to make an offer for a property that's more than what they're asking for? This is really common right now, that people are overbidding and trying to outbid one another on a home. And there are a lot of things that a real estate agent can assist you with in terms of renegotiating your contract and things like that. Oftentimes, if there is an appraisal that were to be done by the lender, which is almost always required on a home purchase, a full interior appraisal of the home. If the value comes back less than what you've agreed to pay, there are different options, such as renegotiating and challenging the home appraisal, making up the difference in cash, or sometimes, unfortunately, having to walk away. And we can touch more on that in a little bit later. All right, so this is really the 5 main things that a lender is going to care about. We're going to go into the financing portion now. So lenders care about these main things: that you have sufficient income to support making your payment. This sounds really obvious. Unfortunately, in the past, this was not always the case. In the past, lenders were not so interested that you could, in fact, make the payment. They were more interested in having loans close. There are a lot of laws that went into place about 10 years ago that now require all lenders to ensure that you can, in fact, afford the home payment. So we want to see that. We need to know about your employment and income history. We need to know that you have a sufficient FICO score. So your credit is very important for all types of mortgage loans. That you have, if you're making a down payment, that you have a sufficient down payment and one that meets our guidelines. And we need to know where and how the funds that you'll need for closing and the escrows, where they're coming from. All right, so this is just a little rule of thumb when you're trying to figure out roughly how much you might qualify for. We're going to do and look at actual calculations for debt to income, but generally, if you have a significant amount of debt, so that's maybe between 2 applicants, 2 car payments, student loan payments, and a lot of credit card debt, you can generally consider 1.5 to 2.5 times your annual income is generally the amount that you could qualify for a loan. If you don't have much debt, you can qualify for 3 to 5 times. So these are just a general rule of thumb. And this is how lenders qualify you based on your income and debt. This is your debt to income ratio, which is one of the most important numbers in the finance process. So you can figure this out. In this example, we have, let's say this is combined income for let's say for 2 people of $10,000 per month. Lenders are going to look at 50% of your gross monthly income. So in this example, $5,000. We subtract your monthly debt payments. So debt is going to be considered any item as a minimum payment that's on your credit report, plus any obligations that the government requires you to make, such as minimum child support, minimum tax payments if you are on a repayment plan for back taxes. Also, if you have an agreement for alimony, something like this. So in this example, $1,500 could be, you know, a car loan and some student loan payments and a minimum on a credit card, maybe a small personal loan. $1,500, what remains is going to be the maximum that you can have as a future housing payment. That number may not be the best number for your future housing payment. If you have very little debt and you have a lot of income and the number that remains is $7,000 a month, you may not want a housing payment of $7,000 a month. That's may not be a reasonable thing to do. However, that is the maximum that a lender may qualify you for. So the number we end up looking at is we take what you do want as your housing payment. So say you want to buy a condo, put 3% down, and the housing payment on that will be $2,500. And you have $1,500 a month in monthly debt obligations. So you have a total of $4,000. We divide that into your total income, and that would give you a 40% DTI, or debt to income ratio. And that is a very solid number. 50% is the absolute maximum that a lender can allow. So your max debt to income is 50. Truthfully, it's believed by financial advisors that a number under 30 is really the most ideal scenario, so that you have sufficient other available income in order to save for the future.
And Liz, a quick question came in about this payment. Does that include the taxes?
Yes.
So include utilities?
Principal, and it will not include utilities. So your housing payment, and I have a slide on that. I'm just gonna see if I can, I'm gonna pop down to it. Okay, so this is an example of a complete housing payment. And this is just an example of a housing payment for a home that is being sold for $500,000. It has a 3% down payment, so the loan would be $485,000. The interest rate at the current prevailing rates about 3.125%. This is pretty reasonable right now for a 30-year fixed rate mortgage, which is the standard and most popular loan that people take. And for this total housing payment, it's broken into principal and interest, which is normally shown to you as one number. I have split it into two figures for you so you can see based on, this would be the very first payment of 360 payments, where the principal is 814 and interest is 1263. Your property taxes on a $500,000 house in Massachusetts might be about $500 per month. Your homeowner's insurance, $125. I've used the calculation for private mortgage insurance of a 700 credit score with 3% down payment, might have a payment of $222 per month in PMI. And in this example, I put in a $50 HOA just to remind you that if you were in, let's say, a development that had a homeowners association where they collected some funds, maybe it's a private road and everyone on the street has to pay a little bit into for plowing. It's not that common in Massachusetts. It is common around a lot of the rest of the country, but New England, not so much. That number would be likely higher if you were looking to buy a condo or a townhouse where there's a larger association that might include insurance. In any case, this entire set of figures here would be considered your total housing expense. So in this $500,000 purchase price with 3% down, you have a total housing payment of $2,974. So I hope that answers your question.
And that's for the payment, but when you're calculating the debt to income, though, you're not including utilities in that.
Not including utilities, correct.
Okay.
That is something that we don't, it's very variable and, you know.
It's above and beyond.
Yep, exactly. So you
Thank you.
personally should consider the cost of utilities in your own budget when you're deciding to buy a house that costs any amount that you think is near the maximum. You ought to ask the questions. A lot of times sellers, most of the time are filling out documentation ahead of time that has estimates of how much the prior year they spent on oil for their heating system or propane or whatever the utilities are. They can give you an estimate so that you can figure out, okay, it's going to be an extra $300 a month that I need to consider as part of my housing expense. It's just not something that the lender is going to count. All right. So I mentioned before, employment history is one of the important pieces of what a lender looks at. So generally speaking, you do need to have at least 2 years of employment history in the field that you're working in. One big benefit, though, is if you do have a degree, education can count as part of your employment history as long as it's in the same field, or as long as you can convince your loan officer and the lender that it's very, very close. However, if you are self-employed, that is a different question. So self-employed individuals typically need to show 3 years of having run their business successfully with increasing income. So Occasionally, if you moved from the same industry to start your own business, and you had previously worked as a W-2 employee and you became self-employed, 2 years might be sufficient, but it's definitely something you want to talk to your loan officer about. All right, so this is something I want to mention because a lot of people come to me and they say, I saw this house for sale. And this was a real example. It was $389,000, and it tells me that the payment is only $19.26 a month. And I ran the numbers with them and said, your maximum housing payment is $2,000 a month. And so you want to find a house where the payment is less than that. And they saw the example on the left from realtor.com where it says estimated payment of $19.26. And if they were to go and look at Zillow, the default figures might be different, and it shows $2,349. And why is that? That is because the information has not been properly calculated in the housing payment information section of the site. So all of the different online listing companies have a section where you can customize the calculations and put in the actual information that you already know about. So I think, let's see, so Realtor shows 3% down, whereas Zillow was showing 20% down payment. So that makes a huge difference in what the total housing payment's going to be. Additionally, one showed it with no taxes and insurance and one with. So in order to see the actual housing payment that a lender is going to look at, and most importantly, what you would have to actually pay, you want to make sure you calculate it properly. And that's all typically available somewhere on the page. Right, we talked about this. All right, and the next point that lenders are looking at is credit. So my recommendation is that everyone should have a good idea of where their credit score is for all three credit bureaus at almost any given point in your life. If someone were to impolitely ask you at a party what your credit score is, you should be able to know the answer, although not tell them. So which credit scores does a lender use? The vast majority of lenders are going to use all three of the major credit bureaus, TransUnion, Equifax, and Experian. We use the middle score, which is typical. And if you have two applicants, you really do want both applicants to have very similar scores, because we are going to look at the three scores. We're going to pick the middle score, and then we're going to pick the lower of the two middle scores. So if you have two people applying for a loan together and they are not equally yoked and one score is much lower than the other, it's very likely that the lender is going to choose the lower of the two applicants' scores. So it's important to have conversations up front if you plan to buy a home with another person, to make sure you're on the same page. The very best credit score for a mortgage is going to be 760 or higher. That is going to give you the very best PMI rate. If you are not going to be putting 20% down, you are likely going to need private mortgage insurance. And the private mortgage insurance is based on risk. The insurance is to protect the lender if you default, and part of defaulting on a mortgage is directly related to if you've defaulted or made late payments on your other debts. So your credit score is a very good indicator. So the higher the credit score is going to mean the lower the risk, and therefore the lower the rate on your private mortgage insurance, or PMI. So having a 760 score or higher is attainable for everyone. There's a lot that can be done to help you improve your credit if it's not in the best shape. It does take time. It takes a lot of work. Folks in the branches can help you. We have information on our website about our balance program and a lot of different assistance and tools for assisting with your credit. 740 is going to give you the best interest rate available. If your scores are not there and you're still looking to buy a home, it is totally possible. 620 is going to be the minimum with a credit union like Hanscom. There are some lenders who offer an FHA product or a few other government loan products that will offer a lower credit score, such as a 580. They are typically, they have certain restrictions, and there's definitely a benefit for locating these products if you have that type of score and are still looking to purchase a home. Hanscom does require 620 or above. Anyone have questions on that? Okay.
I am not seeing any, Liz, so I think we're doing.
Okay, great. Thanks. All right, so we talked about how property taxes are generally going to be part of your total housing payment. And for first-time home buyers who have never paid property taxes to a town or city before, Hanscom is going to require that you have us handle your taxes. And so your property taxes that are owed to the town or state or county, depending on where you live, are going to be part of your mortgage payment. And one thing to note is that property taxes can differ drastically. So current tax rate in Nashua, New Hampshire right now is $22.61 per thousand of value. So if you are buying a home and the town has determined that the value of the home, this isn't necessarily the sales price, but it's the value that the town has determined. If that value is $400,000, the math on that would be, oh, I have a typo here. My apologies. It should say $22.61, not $11.61. $22.61 times 400, which gives you $9,000 a year in taxes. Broken down per month is $753 per month in property taxes. For a home that's worth the same amount in Woburn, Mass, where this actually is one of the lowest tax rates in the area. I think the average right now is about $12, but $9 per thousand with a home value of $400,000. Your monthly tax payment as part of your mortgage payment is only $311. So that is a really big difference. As most of you, I imagine, may know, if you're from this area, a home in Nashua for $400,000 may be very different from a home in Woburn for $400,000. So there's certainly benefits to buying in a town with a high tax rate if you can get, let's say, more square footage for what you're looking for than in a different location. One thing to note is not all states pay their taxes quarterly. So Massachusetts property taxes are almost always paid quarterly. And you are now wondering why that matters if you pay it monthly, because you're paying it to your lender. It does matter because when you close on a home, you typically have to put aside some money for your taxes on the day that you close, because if you close in May and your tax bill is due in June, the lender won't have collected anything from you to pay your tax bill. So we collect, in Massachusetts, we tend to collect 3 months. So in that instance, in Woburn, $900 would be required at closing with your closing costs, so we can pay your taxes. In Nashua, this is definitely a lot higher, at closer to $2,100 or $2,200 would be collected. So it's important to consider. It's a lot of different loan products that you can talk to your loan officer about, whether you want a fixed rate or an adjustable rate. There's a lot of questions that the loan officer will ask you about how long you plan to stay, if your income is going to change and increase, or if you in the future may not be working for some reason. That will help the loan officer guide you in what type of product you're going to take. I want to quickly mention that Hanscom does offer a no money down product. This is, again, only for first-time home buyers. You do have to have a 720 or higher FICO score. That debt to income ratio that we talked about earlier, where the standard is 50%, it actually drops to 43%, meaning less of your total income can be used for a housing payment. So it is harder to qualify for this loan product, but it allows you to buy a home without a down payment. And for a lot of folks who have high rent payments, it's difficult to save enough for a sizable down payment. There are certain restrictions. The maximum loan amount is $548,000. It's available only in New England, Virginia, Maryland, and DC. It's limited to single family homes and condos, and you can't have a non-occupant co-borrower like a parent who isn't going to live in the home. However, although there's a lot of restrictions, it is a really great product for people who are trying to purchase a home without a whole lot of assets available. And this is just a quick upfront mortgage cost examples. You can think about how much you might need. In this example, purchase price of $500, down payment of 3%. That's $485,000 loan amount. Closing costs as an estimate are about $6,000. We talked about escrows before, so that's going to be your property taxes. A couple months of property taxes so that we can make sure we have enough to pay. Also, it's usually some homeowners insurance and things like that. So that could come out to about $4,000. So in this example, you are likely to need about $25,000 to close on a $500,000 purchase price with 3% down. All right. And so this is information about your possible down payment sources. So if you're going to be making a down payment, funds do have to be seasoned. Seasoned funds are funds that are in your checking or saving account for at least 2 months. You can typically, most products, you can use a gift from a family member or a grant or some sort of down payment assistance programs. You can use net equity. So if you already own a home and you're going to be selling that home, you can use the funds from the sale. You may not even have the funds in your possession. Many people will close on the same day and the funds will be transferred by attorneys. Or you can have a gift of equity. A relative could be selling you a house for less than what it's worth. And many people will utilize their retirement systems where they can take a loan from their 401k or other types of retirement accounts, which can be used for a down payment. Most important thing is that you cannot use funds that are not secured. So you can't take a loan against your credit cards or something like that, or borrow money from a friend or family member in order to make your down payment. It has to be a gift with a gift letter, or it has to be some sort of secured account like a 401k. All right. And Bill, are we just about at the end?
And to jump, get myself off mute. We have a bit of time left, and there's plenty of time for questions too. So please.
Oh, good. Okay. Thank you.
In the chat.
For confirming. I appreciate it. All right. So this is all about title insurance. So this is something that I want to share with you guys that is not commonly talked about because it normally sounds really boring, truthfully. Owner's title insurance and lender's title insurance. So title insurance is the only insurance policy that you are going to have in your life that protects you from the past. So a title insurance policy is protecting you from the moment, really, there's some language about the moment the earth existed, really. It just means when the land was first in existence that the house is on, and it is protecting the chain of title and ownership from that earliest point up until the present time. And it protects you from what is called defects on title. that can cause major problems. So there's a story of a family in Massachusetts who purchased a home like anybody else, bought their house, moved in, had a good closing, started doing major renovations and updates to the home. And about 7 years later, got a knock on the door from a woman who advised that she was the owner of the property, and that although they had been making their rent payments, she was sure faithfully to her sister had passed, and so now she was coming to meet them and to start taking their rent payments. Obviously, the people who have owned the home for 7 years were shocked, horrified, confused, and it asked her to go away. At which point she came back with a lawyer and said, this is definitely my house, not theirs. And it turned out that the sister who had recently passed away had fraudulently sold them this house and forged her sister's signature on the documents. And truthfully, the sister who came to the door did have rightful ownership of this home, although this other family had been there 7 years, paying the mortgage, making renovations and upgrades. At the time that they closed, they were offered owner's title insurance, and it was $1,000 or so. And they decided not to buy the owner's title insurance policy. The attorney was their friend and thought that they were being foolish and paid for it out of his commission. And that was their saving grace, because it ended up being decided by the courts that the sister who had had her ownership taken out from under her fraudulently was owed the full value of the home, which I think was close to $750,000, along with reparations for damages done to the home, like removing traditional trees that were on the grounds and things like this. And having the owner's title insurance policy paid for all of those things, as well as the cost of the attorneys who spent 2 years going to court with this woman to make sure that this was settled properly. So for $1,000 or some amount, that's a one-time cost that you pay for when you buy the property. Although it's unlikely that a crazy situation like this would happen to you, if you didn't have it, you could potentially lose everything. So it says optional on all paperwork that you'll see going forward when you're trying to buy a house, but remember the story and how it's a small price to pay for the risk that could happen. All right. Another thing people tend to ask me about these days when property prices are so high is, can I buy a foreclosure or a short sale, or what is a distressed property? What does it mean if something is as is? And these are scary pictures here. And I imagine not what you're looking to buy if you're looking to buy in a move-in ready property. And that is what a traditional lender like Hanscom is going to require, that you can purchase a home that is move-in ready. Sometimes that can be a foreclosed property or a short sale. And a foreclosure is simply just when the prior owners were unable to make their payments for long enough that the bank took over the home. And a short sale is when the current owners can't make their payments and their current lender agrees to let them sell it for less than what is owed. These are examples where a family might be living there, taking care of the property and maintains it to the best of their abilities, and it's in great shape for a purchase. The examples on this page are obviously not that case. So there are certainly times with a current, with your current credit union that you could purchase a foreclosed home. But again, it would have to be in move-in ready condition. What just happened? Okay. So these are some things that you want to avoid while you're going through the process. You want to avoid changing jobs or becoming self-employed. You want to avoid making big ticket purchases prior to your closing. I recently had someone buy a Tesla with a $1,400 a month payment the week before he bought his house, and he was not able to close on his home purchase unless he got rid of the Tesla he just bought. So something like that can cause a big problem with your debt to income ratio. So once you start the process of buying a home, you don't want to make any major changes to your credit situation, which includes using your cards to buy furniture before actually closing on the house, or letting any payments fall behind. Sounds obvious, but you don't want to spend the money that you've saved for your down payment. You want to avoid changing bank accounts unless you have backed up and saved all of the statement history that you might need. And you want to avoid signing for a co-borrower. I have seen this happen a number of times, that although the buyer understood that they shouldn't take out a car loan, they have co-signed for a sibling who needs a car loan or student loan. And unfortunately, that does add to your debt to income ratio for a payment for someone else. So these are some of the major things that we recommend you don't do while in the process. And here is my number one piece of advice. Okay, if you want to buy a house with a total housing payment of, in this example, $2,200, and right now you're paying rent for $1,650 a month, immediately I recommend that you take the difference. In this case, 2,200 minus 1,650 is 550. And you want to start making practice payments by putting the $550 difference into an account the same day that you make your rent payment. That way, on the first of the month, when you're making your rent and putting aside the rest into your savings, you will actually be practicing making $2,200 a month in a future mortgage payment. And if that's really hard to do, and after 6 months, you're finding that you can't afford to put gas in your car, then you shouldn't have a housing payment of $2,200 without making other substantial changes. This is the best way. Certain people who, do not do any sort of practice and don't save, maybe they're getting a gift for the majority of their down payment. Their first payment can be very shocking. And this is a good way to prevent that. It helps get you more money into your savings account, and it overall makes a much better situation. And no one has ever done this and been unhappy that they did this. It only provides you a big benefit. So I highly recommend. And I just want to thank you guys and wish you luck. And please let me jump on, use the chat feature, however you want to do it, and let me know if you have any questions.
Thank you, Liz. I did. Please, if you have a question, go ahead and put it in the chat. We have a small enough group here. I'll just go for it and say, if you want to just unmute and ask, you're welcome to do that too. But I was wondering, you mentioned a couple of times how crazy this market is. And my wife and I were looking to downsize, and we're running into this too. Houses are being bid up. And you're waiting in line at open houses to walk through a house for 15 minutes. It's just an insane market. So given the market that's now, what do you advise just as far as steps? Should we do a pre-qualification or should we do a pre-approval, or what's the best way to go about being prepared?
Thanks, Bill. So I'd say the very first thing that I recommend everyone do is to actually have a call with a mortgage loan officer and figure out your own timeline and whether or not you're at that point you're ready to have to get a pre-qualification letter. A pre-qualification letter is not going to require that you provide all of your income documents. It's just a check of your credit and an application asking you to state your income honestly and clearly. And at that point, we would provide a pre-qualification letter for you that's good for 4 months. Yep.
Okay, we're getting some questions rolling in now.
All right, great.
Maria's gonna have to help me keep up with them. I'll start with the first.
Oh, did we lose Bill?
Yeah, I
Okay.
lost you, Bill, but I'm pulling up the chat here.
Yeah.
So I'm gonna,
The first one was in regards to the non-occupant co-borrowers. What does that mean? Can you run that
yeah,
through again?
so a non-occupant co-borrower is anyone who, non-occupant, meaning they are not going to occupy the property, but they are on the loan. So this is allowed on almost any product that we have except for the no money down product. So you can, if you don't have sufficient income to qualify to buy a home on your own, and there's someone else who's willing to have to be on a mortgage loan with you, but they don't live in the house, that is an acceptable way to qualify for a home. So I have seen this with parents who would like to support their children, are willing to sometimes be on a home loan with them, or the alternative. I've actually probably have an equal number of loans in my pipeline right now that have a non-occupying co-borrower as either a parent or a child.
Oh, great. The next one would be, is there a no money option offered in Massachusetts?
Yep. So the no money down option that I talked about is available throughout all of New England. So that includes Massachusetts, as well as the Nova area in DC. So that's certainly possible for you in Massachusetts. Yeah.
Excellent. And the next question is it better to have a pre-approval letter from a well-known bank versus a credit union? Have you encountered an issue with your potential borrowers, or do you think this would make a difference?
Yeah, so truthfully, there are very few markets where a pre-approval seems to be absolutely necessary. A pre-approval is when all of your documentation has been reviewed in advance. A lot of times that is done for a fee by larger banks. I have not had any of my members in the 7 years I've been at Hanscom have a problem using our pre-qualification letters. They get their offers accepted with a pre-qualification from Hanscom. So that hasn't been a problem. If you are in a market that your agents are saying that they do need a pre-approval, then that's something, you can certainly look to get.
The next question, they mentioned something about skipping over slides. Did you go back to those slides? I think you did.
Yeah, I did. I think I skipped one or two that were related to VA home loans because I had a suspicion that this group may not have interest in veteran related mortgages. But if anyone does, I can certainly chat about that.
Excellent. Next question,
It's
does a pre-qualification?
PITI,
Pardon?
PITI, what, that's,
Principal, oh, sorry, that's principal, interest, taxes, and insurance.
Okay.
And that letter insurance includes homeowners insurance, includes private mortgage insurance, and sometimes potentially flood insurance. PITI.
Excellent. Does pre-qualifying involve a hard pull on the credit report?
It does, yep, it absolutely does. So that we can have all of the full information related to your current debt obligations. One thing that's important to note is that with mortgages, and actually with any different type of product that you're applying for, you can actually have as many hard credit inquiries as you want in a 30-day window. So if you're applying for a mortgage and you want to compare lenders, you have 30 days to apply for as many different lenders as you'd like, as long as it's only for a mortgage credit inquiry. All of those inquiries will still report on your credit report, but the impact will only be once. That's true as well with different types of loans. If you're searching for an auto loan, all of the auto lenders that you apply with are going to show up on your credit report, but it will only count as one inquiry as long as it's within 30 days.
Excellent. Next question, can you go over the difference between pre-qualification and pre-approval?
Yeah, so pre-approval is, Hanscom does not offer a pre-approval program. Not a whole lot of lenders do. It means that before you even have an agreement on a property, the lender would do a complete full underwriting of all of your documentation, and they would give a letter that states that based on a full review of this information, we will be able to provide a loan of X. Again, it's not that common. A lot of most lenders offer a pre-qualification that reviews credit. That's the standard. But there are lenders who offer a pre-approval, and in certain markets, typically the only market that I see that tends to require that is in a lot of Northern California.
Excellent. Next question. What are some options for a person with low income but having the down payment saved?
Well, the more down payment that you have, the better your option. You know, I'd say the options are, well, I'd say I'd love to have a conversation with you and we can run some numbers. There are a few products out there that if your income is truly low, that there are some additional supports. But I'd be glad if you want to reach out to me. We can run through some of that individually.
Excellent. The next question is about taxes. Taxes taken out each month combined with your mortgage. Do we get interest from the account since money will be sitting there for months at a time?
Yeah, not very much though. Very, very, very little, and you won't even notice it. So after 2 years of making your mortgage payment on time, you can request that the lender let you pay your property taxes yourself so that you can keep your own money in your own account, making whatever interest is available to you, and pay your taxes yourself. That's what a lot of people do. Personally, I don't want to be responsible for that. And I know that my lender is going to handle it. And it's not so much that, the comfort of having my taxes paid on time is more important than the risk of me forgetting. So usually lenders require 2 years of on-time payments before you can request to pay your taxes yourself.
And then as Bill mentioned, we are recording the session. So we will be sending an email with the recording of this session along with the slides of this session and Liz's contact information. So if you had some spotty internet, because I know we've had some comments on, in and out internet, you will be able to get this presentation. So don't worry, we'll get you all that information. We have your email once, we'll send that to you sometime this week. There's an additional question. Are there any age limits for seniors, and do the same rules apply for nothing down? So 2 questions.
So absolutely no age limits of any kind. I gave a mortgage to a 100-year-old man, and there not a single question because there can't be. That's against the law. So no, of course not. If you want a 30-year mortgage when you're 100, go for it. Absolutely, no problem.
Good for you.
Yeah. So I don't know what that second, does the same rule apply to nothing down? Are you referring to, are there age limits for the nothing down loan? Yep, absolutely not. Nope, no problem. You do have to be of age to consent to signing legal documents, though. There is a low age limit, but not a high age limit.
Well,
Any other questions? Excellent questions. Bill,
Yeah, thank you.
did you get any questions on your side?
no, I'm all set on my side. Sorry, I disappeared on everybody. My internet went out, blipped out. So I'm sure I had a funny expression when I did. So well, thank you everybody for your attendance. I will be sending out that email. Give me till, what's today, Tuesday? Give me till Thursday afternoon to get that information out to you, and I will. It will also have Liz's contact information. Like I said earlier, I've worked with Liz for quite a while now, and I can tell you honestly, she's very happy and very patient to sit and answer questions, run numbers with you, just walk you through what you need to put together just the best mortgage, the best home buying process you could ever want.
Thanks, Bill.
A dream to work with. So I thank you all very much for your coming today. Please don't hesitate to reach out if you have any questions, and I will be in touch by Thursday afternoon. I'll have a first-time home buyer's guide. I'll have the slides, and unless my technology really glitches, I should have a link to a recording for you. Thank you for joining us today. Have a wonderful afternoon, and best of luck in your home search.
Thank you.
Thank you. Bye-bye.
Thanks. Bye,
Bye,
guys.
everybody.